For years, we've been told that rent is dead money, a complete waste compared to the wealth-building potential of owning a home. But what if that conventional wisdom is profoundly incomplete, even misleading for many? Consider this. The average homeowner spends an additional 3.7% of their home's value each year on hidden costs beyond their mortgage principal and interest. If you buy a $400,000 home, that's an extra $14,800 annually just disappearing, not building equity. This widespread belief costs people thousands by pushing them into unsuitable financial commitments. Today, we're busting the myth that renting is always throwing money away, revealing the often overlooked financial advantages it can offer. Let's kick things off with the initial hurdle of homeownership, the hefty upfront costs. Buying a home isn't just about the down payment, you're also slammed with closing costs. These are fees associated with the purchase, including lender fees, title insurance, appraisal fees, and legal fees. On average, closing costs typically range from 2% to 5% of the home's purchase price. So on that $400,000 house, you're looking at an extra $8,000 to $20,000 out of pocket before you even get the keys. This immediate cash drain significantly reduces the money you have available for other investments or an emergency fund, making the rent-free dream quite expensive from day one. Beyond closing costs, the mortgage itself can be a deceptive beast, especially in the early years. Many people focus on the monthly payment, believing a large portion goes towards building equity. However, a significant chunk of your early mortgage payments is allocated almost entirely to interest, not principal. For instance, on a $320,000 mortgage at 6% interest over 30 years, your first year's payments total about $23,000, but only around $4,000 of that actually reduces your principal. The other $19,000 vanishes into interest payments. This means it takes years before you see substantial equity growth, contradicting the quick wealth-building narrative often pushed. Next up are the recurring, non-negotiable costs that come with homeownership, property taxes. These are imposed by your local government and can vary wildly depending on your location and property value. For our $400,000 home, in a state like Texas, annual property taxes could easily be 2% to 3%, meaning $8,000 to $12,000 every single year. These taxes can also increase over time, often unpredictably, adding another layer of financial uncertainty. Unlike a fixed rent payment, property taxes are an ever-present, escalating expense that doesn't contribute to your equity, but rather to public services. Alongside property taxes, homeowners insurance is another mandatory expense. Lenders require it to protect their investment, and it protects you from unforeseen disasters like fires or natural calamities. The average homeowner pays around $1,700 per year for insurance, but this can skyrocket to $5,000 or more in high-risk areas prone to hurricanes or wildfires. These premiums also tend to rise over time due to inflation and increasing climate risks, making it another unpredictable cost that adds significantly to your monthly housing budget. Renters typically don't face these direct insurance costs, as their landlord covers the building. Perhaps the most underestimated cost of homeownership is maintenance and repairs. When something breaks in your own home, you are responsible. Experts recommend budgeting 1% to 4% of your home's value annually for these expenses. For that $400,000 house, that's $4,000 to $16,000 per year. Think about it. A new roof costs $10,000, a new HVAC system $5,000, and unexpected plumbing issues can easily hit $500. Renters just call their landlord for these issues, saving them immense financial stress and unexpected costs. This hidden repair fund obligation is a significant financial burden on homeowners. Beyond emergency repairs, there's also the ongoing elective maintenance and upgrade costs. Homeowners often feel compelled to invest in landscaping, painting, or kitchen renovations to maintain or increase their home's value and desirability. While some of these might yield returns when selling, many are purely cosmetic or for personal enjoyment, sinking more cash into the property without immediate equity gains. Think about the thousands spent on a new deck or updated appliances. These are choices renters never have to make, allowing them to allocate those funds elsewhere. This constant demand for upkeep is a silent drain on a homeowner's finances. Another less tangible, but equally impactful cost of homeownership is the lack of flexibility and mobility. Life happens. Job opportunities arise in different cities, family situations change, or you might simply want a different environment. As a renter, breaking a lease might involve a penalty of 1 or 2 months' rent, but selling a home is a far more complex and expensive ordeal. Selling costs, including realtor commissions, typically 5–6%, staging and repairs, can easily chew up 7–10% of your home's value. For a $400,000 home, that's $28,000, just to move. Renters maintain the agility to adapt to life's changes without incurring massive financial penalties. Now let's talk about opportunity cost, the hidden financial sacrifice of tying up a large sum of money in a down payment. Imagine you have $80,000 for a 20% down payment on that $400,000 home. If you chose to rent instead and invested that $80,000 in a diversified index fund, earning a historical average of 8–10% annually, that money could grow significantly. Over 10 years, $80,000 invested at 8% would become over $172,000. That's nearly $92,000 in investment gains you're foregoing by putting it into a down payment that might only appreciate modestly, if at all, in the short term. This powerful financial concept is often ignored. This concept extends to your monthly housing budget. When you rent, your housing cost is often much simpler and potentially lower than the true cost of homeownership, as we've discussed. The difference between your rent payment and what a homeowner would pay in mortgage, taxes, insurance, and maintenance can be invested monthly. Let's say your total rent is $2,000, while the equivalent ownership costs are $3,000. That extra $1,000 per month, invested consistently at 8% for 20 years, would compound to over $590,000. This rent money can become powerful wealth-building capital, rather than just covering fixed housing expenses that don't always yield the expected return. Another crucial factor is diversification. When you own a home, a huge portion of your net worth is typically tied up in a single illiquid asset, your house. This means your financial future is heavily exposed to the local housing market's whims. If the market declines, as it did in 2008, your wealth takes a direct hit, and it's difficult to access that capital quickly. Renting, however, allows you to diversify your investments across stocks, bonds, and other liquid assets. This strategy spreads risk and often provides greater stability and growth potential for your overall portfolio, rather than putting all your eggs in one geographical basket. The housing market itself is not a guaranteed upward trajectory, despite what many might think. While real estate historically appreciates over the long term, short to medium term fluctuations are very real. Property values can stagnate or even decline, especially if you need to sell during a downturn, as millions experienced during the 2008 financial crisis. For example, some homeowners who bought between 2005 and 2007 saw their property values drop by 20–40%, leading to negative equity. Renters are insulated from these market risks, avoiding potential losses and the stress of a depreciating asset. Your housing cost remains fixed or predictable with lease renewals, unlike a home's value. For young professionals or those early in their careers, renting offers a clear advantage: career flexibility. Many entry-level jobs require relocation, or you might pursue advanced education in another city. With homeownership, these transitions become incredibly cumbersome and costly, as we discussed with selling expenses. Renting allows you to take advantage of new opportunities without the shackles of property ownership. This flexibility can lead to higher earning potential over your career, as you're free to pursue the best roles, not just the ones within commuting distance of your property. Your career advancement isn't dictated by your address. Let's also consider the lifestyle freedom that renting provides. Many apartments or rental communities offer amenities like gyms, pools, and shared spaces that would be incredibly expensive or impossible to maintain as an individual homeowner. Think about the costs of installing and maintaining a private pool, often $50,000 for installation, plus thousands annually for upkeep. Renters get to enjoy these perks without the financial burden or the time commitment of maintenance. This allows more disposable income and free time for hobbies, travel, or personal development, enhancing overall quality of life. You're paying for convenience, not capital expenses. While often praised as a path to wealth, homeownership doesn't always guarantee appreciation that outpaces inflation or other investments. From 1980 to 2020, the average annual return on residential real estate, after accounting for inflation and costs, was closer to 1–2% in many markets. Compare that to the S&P 500, which has historically averaged 7–10% annually after inflation. This isn't to say real estate is bad, but it underscores that money tied up in a home isn't necessarily working as hard as it could be in other asset classes, especially for short to medium hold periods. Many homes are simply expensive places to live, not financial rockets. For those just starting out or carrying significant student loan debt, renting can provide crucial financial breathing room. A large mortgage and the associated costs can severely limit your ability to pay down high-interest debt, build an emergency fund, or save for retirement. If you're saddled with $50,000 in student loans at 6% interest, freeing up $500 a month by renting more affordably could accelerate your debt repayment by years, saving you thousands in interest. Prioritizing debt elimination and establishing a solid financial foundation through renting can set you up for greater long-term wealth before taking on the burden of a mortgage. So when is renting the smarter choice? It's often ideal if you plan to move within 5–7 years, as the transaction costs of buying and selling typically outweigh potential appreciation in that time frame. It's also financially savvy if your initial investment capital, down payment plus closing costs, can generate higher returns in liquid investments than the likely appreciation of your home, after all expenses. Essentially, if your rent savings can be channeled into a robust investment portfolio that outperforms the true, all-in costs of homeownership, then renting becomes a powerful wealth-building tool. This requires honest comparison, not just emotional decisions. Conversely, when does buying make sense? Buying typically becomes financially advantageous when you plan to stay in one place for 7–10 years or longer, allowing enough time for transaction costs to be amortized and for potential equity to build up. It also makes sense if you have a stable income, a substantial emergency fund, and are prepared for the financial responsibilities of maintenance and repairs. Furthermore, if you anticipate significant appreciation in your local housing market and can secure a good interest rate, buying can indeed be a solid investment. However, these are specific conditions, not universal truths. Ultimately, the decision to rent or buy is deeply personal and depends on your unique financial situation, lifestyle, and future goals. There's no one-size-fits-all answer, despite what societal pressure or well-meaning family might suggest. Instead of blindly following the rent is throwing money away mantra, empower yourself with the facts. Calculate the true costs of homeownership in your desired area versus the cost of renting, and compare the opportunity cost of your down payment. Use online calculators and spreadsheets to make an objective, data-driven decision that aligns with your financial well-being. This requires self-awareness and diligence. So the next time someone tells you renting is just throwing money away, you'll have a far more nuanced and accurate perspective. It's about smart financial planning, understanding all the costs, and leveraging your money where it can grow best for your circumstances. Don't let outdated advice dictate your biggest financial decisions. Instead, focus on building wealth through strategic saving and investing, whether you choose to rent or buy. Your financial freedom comes from informed choices, not just conventional wisdom. Take control of your money story starting today. Thank you for watching and empower yourself with knowledge.